So today I'm going to talk to you about paying profits first and the profit first methodology. So we live in a world addicted to axioms. So what's an axiom, I hear you say? I'll share by way of an example, and the simple one being the world is flat. In ancient times, you've all seen them. You've seen the maps that sort of show at the edge of the area there's all the sea monsters and sea serpents, and there was that commonly held belief that if you sailed off the edge of the map that you would disappear, never to return. It wasn't until sort of 500 BC that philosophy started to come up with the notion that the world may actually be round. It wasn't until a further 2,000 years later that it actually got proven by Christopher Columbus when he sailed around the world. But during that 2,000 years, there was still the commonly held belief that the world was flat. Even though people had come up with the theories, they'd put all the information out there to prove why it could actually be round. And that's what an axiom is. It's something that's just so ingrained into society or knowledge that it's just handed down and people just accept it as being true. So I'm here to tell you today that the generally accepted accounting principle notion of profit is one such axiom, that it is in fact a little bit of a lie. And so what is that formula? Hopefully, if you're in business, you at least have a bit of an idea of what that formula is. And it's this. It's the revenue minus expenses equals profit. So hopefully you've actually been in this position in some form. You get to the end of the financial year and the accountant says to you, you've made a profit. And you go, awesome, brilliant, that's great. The second question that may then come into your mind is, where's the cash? And you might ask your accountant that, where is the cash? I've made this profit, where is it? And the accountant might say, well, that's your book profit. You've already spent that money. The notion I'm here to say here today is to flip that equation on its head. It's basically to say that revenue minus profit equals expenses. Now, this is still mathematically correct. It's the two formulas here are both mathematically the same. No wizardry going on, although it does remind me of a little anecdote that I have heard in the past and commonly share around accounting and the way numbers can potentially move around. And there was an interview one day where there was three applicants. There was a mathematician, an engineer, and an accountant. And the recruit manager sat them down and asked them one question each. So firstly, he said to the mathematician, what's 1 plus 1? Mathematician went, 2. Okay, cool, perfect. The engineer walks in, what's 1 plus 1? The engineer had a think and goes, well, it's 1 plus 1 equals a window. He came up with a window for that. So then the accountant walks in and he goes to the accountant, what's 1 plus 1? And the accountant goes, looks over his shoulder. What do you want it to be? So that's what some people think about accounting and what goes on with the numbers, and it is a pretty light-hearted anecdote, but as you can see there, it's going back to your year 8 maths, and who said you'd ever use that again? All we're doing is moving. We've got the revenue minus profit equals expenses. All we've done from the original formula is flip them around. One becomes a positive, the other one becomes a negative, and it all works mathematically. The important component of this is what it does behaviorally. Now, with human nature, as human beings, we have a tendency to focus on whatever comes first. And in the case of business and the first formula, we're saying revenue comes first. That's all well and good. But the second thing we actually then focus on is the expenses. And profit actually becomes an afterthought. That's not great when you're talking about wanting to grow profit in a business. That the human nature is to focus on what comes first. In our minds, if we're thinking accounting and how we're commonly told by accountants and bookkeepers is revenue minus expenses equals profit. By flipping it on its head and we start to put profit as a priority straight after we're talking revenue, then we start to have more focus on it and there's more energy being devoted to it, then it's more likely to actually happen and us to get the benefit from that. So how does that actually work in practice within business? What we need to do is to actually take a bit of a leaf out of the physical fitness world and put it into our physical fitness. Back in the day, we used to have dinner plates that were this big. These days, our dinner plate is probably double that size. That's why one of the reasons a physical trainer will often tell you, one of the first things they'll mention is to reduce your plate size. If we reduce our plate size, we will consume less. And that's the same with our finances. If we put money aside into different bank accounts, we use bank accounts as different plates, we actually then start to consume less. And that's something that comes from Parkinson's law. And it is that theory around the more I have, the more I'll spend, the more I will do. And you can even come back to your simple little toothpaste. Right here, we've got this awesome little toothpaste here. We can see here that it's been used up over a little bit of time. When I started using this, you know, you're squeezing it out. You don't really care how much you're putting on top of your toothbrush before you brush away. If a bit ends up in the sink, who cares? Happy days. But as it starts to get down to about this level, what do we all start to do? I know I personally, I start to roll it up a little bit. I start to be conservative and really conscious of how much is actually there. I want to make this little puppy last a little bit longer. And that's the same. If we separate our finances out and our money out into separate buckets, we're then actually likely behavior to say, well, I've only got this amount of money. I now need to make that happen. And I can become more efficient, more productive in the way that I actually use that. So with the Profit First methodology then, what we actually do is we look at having 5 core bank accounts. And these bank accounts are income, the first one. We have a profit account. We then have a tax account. We have an owner's pay account. And then we have an operating expenditure account. How that actually works in practice is all the money that we earn and that we bill on a periodic basis, whether it's daily, monthly, whatever it is, goes into this one income account. From there, we actually allocate, based on percentage basis, out into these 4 other accounts and in that order. So we make sure that we set an aside amount for profit. And the reason we do this is that as a business owner, you've actually spent a lot of investment and time, energy, and money to get something out of it. You want to make some money. You need to get a return on that investment. It's no different to if I'm investing in big companies. It works exactly the same. What do big companies do with their shareholdings? They provide dividends. That is the risk you're getting paid back in cash terms, the financial investment that you've put into that company. And so what we're doing is doing this for smaller size business. We're earning income and revenue, time to put a little bit of money aside for all that energy, effort, and expertise that you've put into the business. You need to get a return on that. The second amount that we put aside is for taxation. The biggest person that will come chasing for their money is the government, and you cannot avoid that. And you don't want to get into difficulties where you don't have the cash flow to pay for your GST, for your PAYG, for your superannuation, and those types of things. So we put an appropriate money amount aside for that as well. The third component then is the owner's pay. We have to pay ourselves as the owners of a business in line with what we're actually doing day to day in our business. And this is different from the profit from the business. They are 2 different things. There is the amount of money that we should be reimbursed, the same as if we were working for somebody else. If I'm working as an employee of someone else's business, I'm going to get paid for that according to whatever output I'm actually doing. You need to do that as a business owner. Whatever work you're doing in the business, you need to be reimbursed for that. And so we have a separate account for that as well. And then finally, all the money that's left over after we've done the distributions out into those different areas is then what's left that we actually have to run our business on. And that then means that we have to run within a certain allocation. So if there's not enough money in there for us to do what we want, we have to be more creative. We have to be more efficient. And this process makes us realize that, okay, am I being efficient? Am I being effective? Do I really need to make that expense? Is that something that I need to do today? Or am I getting a good enough return on investment for the amount of money? Because if I'm allocating every piece of revenue gets a little bit going out into these other accounts, then I need to get a good quality return on investment for revenue generating ideas that I might be spending my money on. So that's a very quick, brief overview of the Profit First methodology and how you can pay profits first in your business in under 10 minutes. One key takeaway that I do want you to take here is that even if you don't go out and open 5 bank accounts to start with here today, you can actually start this very simply by opening 1 extra bank account. And do that today. You get 1 extra bank account, call it profit, and from every deposit that you receive moving forward, if you allocate even just 1% of that revenue into that bank account, you will start to see that grow periodically over a period of time. And that then creates a habit. What you've actually done then is you've set aside a small amount of money in the meantime to pay yourself and take out of the business, your reward for being the business owner. But then also you're going to create yourself a bit of efficiency. You now have to operate on 99% of the income that you actually get back into your business. That will, again, make you that little bit more efficient, more productive. Think about how you're doing things. And over time, if that's going well, you can slowly start to increase those percentages. And that's how you can ultimately create a permanently profitable and sustainable business for yourself.